Prepare to see gas prices surge to nearly $7 this driving season. A supply and demand crisis is gripping the market right now, and the national inventory is falling short of experts' estimates for this time of the year. A few weeks from now, paying $4 per gallon of gasoline will become the reality for millions of Americans. And executives in the industry are pointing to higher pressure on crude oil markets, refinery disruptions, and increased volatility as the drivers of the coming price spike that could push the cost of a gallon of gasoline to double or triple in many states in the coming months. We have a lot to cover in this video, but before moving on, we kindly ask you to support our work with a thumbs up and don't forget to subscribe to our channel. Thank you. This is gonna be another tough year for US motorists. We enjoyed a few months of lower gas prices after the historic rise that drove the national average to above $5 in 2022. But now, costs at the pump are surging rapidly, and several factors are combining to create a new price spiral over the next few weeks and months. In an interview with Insider, Gas Buddy's head of petroleum analysis, Patrick DeHaan, warned U.S. drivers to brace for a spike in gas prices due to refinery shutdowns and amid renewed energy demands from China as the Asian nation reopens its economy. 2023 is not gonna be a cakewalk for motorists. It is gonna be expensive, DeHaan noted in the firm's March 2023 Fuel Outlook report. Gas Buddy predicts the national average price of gas at the pump to top around $4 a gallon in most major U.S. cities just a few weeks from now. And by this year's driving season, when demand shoots up amid the summer break, many U.S. cities are likely to see gas prices approach nearly $7 a gallon. Some cities in the West Coast state of California, such as San Francisco, Los Angeles, aren't that far from that average already, meaning that they could see prices 3 times higher than the current national average by the summer. Basically, curveballs are coming from every direction, DeHaan stressed. I don't think we've ever seen such an amount of volatility as we're seeing this year, and that will be a trend that likely continues to lead to wider uncertainty over fuel prices for the rest of 2023, he added. According to the executive, the rebound in gas prices is already starting, and it will only accelerate from here on as refineries close down for maintenance after a rough winter and curb the production of gasoline and diesel. While during this time in 2022, refiners were operating at full capacity, data from the U.S. Energy Information Administration shows that for the week ended March 3rd, refiners were operating at just 85.2% capacity due to heavy maintenance schedules at several key pipelines. Demand, however, has stayed strong, and the AAA says that the imbalance between supply and demand will likely add further stress for U.S. drivers in the next few days. The increasing gas demand amid tighter supplies has contributed to rising pump prices. If demand continues to grow, drivers will likely continue to see pump prices increase, the association noted. In fact, gas prices are set to rise by a minimum of 62 cents by Memorial Day, experts with the association said. The price of the average gallon will continue to rise as the annual transition to more expensive summer-grade gasoline is getting underway. The higher cost of these various blends is going to be passed along to motorists, they wrote. On top of that, shortages in some areas of the country can drive up gas prices locally because of refinery or pipeline shutdowns, blending issues, or even gouging. But it's important to note that big nationwide swings in the price of gasoline are almost always due to the price of crude oil, which is also moving upwards. For the 4th week in a row, the nation's average gas price has climbed, rising 15.3 cents from just a week ago to $3.44 per gallon yesterday, according to Gas Buddy data compiled from more than 11 million individual price reports covering over 150,000 gas stations across the country. The national average is up 30.2 cents from a month ago and 7.3 cents per gallon higher than a year ago. Gasoline prices continued their upward trajectory last week as oil prices pulled them higher across the majority of the country, and continued refinery challenges kept the supply of gasoline from rising more substantially, Dahan explained. Global factors have contributed to higher prices for crude oil and refined products as the Chinese economy reignites and producers increase their orders to ramp up manufacturing activity. Moreover, releases of crude oil from the Strategic Petroleum Reserve have wrapped up. Concerns are increasing that without additional oil, supply will tighten in the weeks ahead, especially as the nation starts to move away from softer demand to spring and summer demand, he continued. Unfortunately, none of this indicates relief for motorists, with prices likely to continue accelerating. China's higher consumption and a weakening U.S. dollar in the global oil market are also likely piling in to put more upward pressure on oil prices. The cost of raw crude oil typically represents more than half of the cost of a gallon of gasoline. Refining, distribution, and taxes account for the remainder. Over time, the price of crude oil and the price of gasoline move with supply and demand. Many factors affect both, including recession, geopolitical conflicts, fewer collaborations among oil states, and tax incentives that can limit supply. The storm clouds over oil and refined markets may persist, and we could see more spikes as the market remains somewhat tight, highlights Anders Opedal, the chief executive of Norwegian energy giant Equinor, as quoted by Reuters. There is very small spare capacity available, so small changes in supply have an impact, he said. It is easy for the market to move in the wrong direction. At the same time, the diesel crisis isn't over yet. Diesel stocks remain critically low a month after the West's fuel embargo went into effect. Ironically, there is one thing that's helped the U.S. avoid a massive diesel shortage so far, and that is the ongoing economic slowdown. Last month, Reuters' John Kemp reported that the U.S. diesel fuel inventories have started the year at alarmingly low levels, thanks to higher refinery run rates and stronger than expected demand for middle distillates. Back then, he forecasted that any pickup in economic activity pressured by inflation could deepen the imbalance between supply and demand, fueling further inflation despite the Fed's efforts to rein it in with a series of rate hikes. But new data released by official agencies last week confirmed that freight transport and manufacturing activity are declining. This would normally not be seen as good news, but when there's a looming diesel shortage on the horizon, and the only thing that's keeping it on the horizon is an economic slowdown, we have to think that, at least, we don't have another catastrophic crisis scrambling things around in the country just yet. Diesel consumption is a good indicator of where the economy is going. For now, it seems that we are on the path of a twofold recession. One artificial, caused by interest rate hikes, and a natural one, caused by deteriorating conditions for businesses and consumers. One look at the oil industry reveals slower spending plans because of inflation and equally slow growth plans because of higher borrowing costs, explained Irina Slav from oilprice.com. The U.S. manufacturing sector has been posting contractions for 4 months in a row. This is not good news GDP-wise. The way out is if refiners ramp up distillate fuels production substantially, but no refiner would ever do that unless there is demand for those fuels on the market. There is also the issue of smaller refining capacity. the result of refinery conversions and closures in recent years. The state of diesel suggests there's still pain ahead for the U.S. economy, Slav outlined. Meanwhile, an auto loan crisis is turning the outlook even scarier, and it's threatening to trigger the biggest wave of car repossessions this U.S. has ever seen. Right now, a growing number of consumers are falling behind on their car payments, a trend that financial analysts fear will continue into 2024. Consumers are having to stretch their budgets to afford a vehicle. Today, the average monthly payment for a new car is up 26% since 2019 to $718 a month, and nearly 1 in 6 new car buyers is spending more than $1,000 a month on their vehicles. Other costs associated with owning a car have also skyrocketed, including, as we've just mentioned, gasoline, insurance, and repairs. There are so many borrowers defaulting on their car loans right now that the repo market can't keep up with lenders' demands. Jeremy Cross, the president of International Recovery Systems in Pennsylvania, says he can't find enough repossession men to meet the demand or space to hold all the cars his company has been tasked with repossessing. Since 2020, the number of repossession companies has dropped by 30%, as many firms closed up shop and the workers found jobs in other industries when repossessions tumbled during the pandemic, Cross said. Now, lenders are paying him premiums to repossess their cars first in anticipation of a continued increase in loan defaults, he revealed. The volume is picking up, and the remaining companies that are still performing repossessions are very busy, Cross exposed. We will see a big wave coming in the rest of 23 and into 24. I think lenders are finally starting to recognize that because in the past couple of years, they offered financial incentives that they never had to do before. They were jockeying for a position knowing that there's only a certain amount of bandwidth available. The problem is escalating so rapidly that it's raised concern among officials at the Consumer Financial Protection Bureau, who say they're seeing troubling signs in the auto market, particularly among so-called subprime borrowers, who have below-average credit scores, and those with loans taken out in 2021 and 2022 when auto prices were abnormally high. Loans taken out in those years are performing worse than prior years just because those consumers had to finance cars once the supply chains were jammed and the prices started to go up, said Ryan Kelly, acting auto finance program manager for the CFPB. Those consumers got hit with inflation twice. First, when they had to finance a car after the prices went up, and then when they had to put gas in the car after the Russia-Ukraine conflict started. So there's just a lot of consumer stress. Conditions in the oil market, the gasoline and diesel market, and in the auto industry are deteriorating faster than anyone could have imagined. A nightmare scenario is now unfolding, and United States drivers should get ready for more pain and uncertainty ahead as the perfect storm begins.